Welcome back to the podcast where we explore how small mistakes, overlooked warnings, and human errors can spiral into devastating consequences. I'm Eckhard Jan, and this is Error 1. It's about everyday mistakes, why we keep making mistakes, and that small triggers sometimes have catastrophic consequences. This episode is about an event that led many people to ruin and almost an entire country to the brink of national bankruptcy. Have you ever watched a financial bubble burst in real time? Stocks climbing impossibly high, people mortgaging their homes to invest, and then, pop, everything crashes. We've seen it with dot-coms, crypto, housing, but today we're going way back. Over 300 years before the words stock market even sounded familiar. This is the story of the South Sea Bubble, a story of greed, corruption, and the birth of modern financial madness. And it all started with a company that promised the world, but barely owned a boat. But what happened? Let's together take a look at the error chain again. The South Sea Bubble was one of the first speculative bubbles in history. The whole thing happened in Europe in the 18th century. The crisis was named after the South Sea Company, which had been based in London since 1711. In 1711, Britain has just emerged from a long and costly war with France and Spain. First in the 9-year War of Revision with France, and then the War of Succession for Spain. The government was drowning in debt, over £9 million, an astronomical sum at the time, and they were desperate for a solution. The English government therefore looked for ways to finance its debts. People have always looked for ways to increase their money. It was no different in the 17th and 18th century in Europe. It was the time of colonization. Many people pooled their money to finance ventures such as overseas trade. Joint, sometimes cooperative companies were used to finance overseas trades. It was really not surprising that many people wanted to participate in this lucrative and very profitable trading companies. Enter John Blunt, a sharp-tongued financier with a bold idea. What if a private company could take over a chunk of the national debt in the UK, and in return receive an exclusive monopoly and trade with South America? Sounds clever, right? That company would be the South Sea Company. The South Sea Company was a public limited company, ostensibly to open up new market in English colonies. In reality, however, it was primarily intended to restructure the English budget and take over the national debt. In return for the assumption and repayment of these debts, the company was granted numerous concessions. The South Sea Company was promised a monopoly on trade between Great Britain and Spain. This applied in particular to trade to the South Seas around South America. Rumors quickly spread that this monopoly would also include the lucrative slave trade. And so it came to pass. As part of the Peace Treaty of Utrecht in 1713, Great Britain secured the right to deliver slaves to the Spanish part of America, to South America. This was seen as a success for Great Britain. Trade with the gold and silver-rich colonies from the Orinoco River down to Tierra del Fuego could generate enormous profit, or at least that was the plan. The stock exchanges in Europe were helpful in this respect. In 1409, the first stock exchange was founded in Brugge in Belgium. England followed suit in 1571 and also opened up its own stock exchange in London called the Royal Exchange in order to trade shares and finance companies. The shareholders of the South Sea Company were convinced that the company would make astronomical profits once it had a monopoly on the slave trade in South America. Everyone wanted to profit from this lucrative business. One contemporary witness said that nobility, ladies, brokers, and lackeys bought shares in the South Sea Company like crazy. From the start, the South Sea Company was more hope than reality, but people didn't care. The company promised riches from the New World: gold, silver, exotic goods. They were selling dreams, and dreams sell well, especially when they are dressed up in financial wizardry. And here's the twist. Instead of paying back government creditors in cash, the company offered to swap their old government debt to shares in the South Sea Company. In theory, everyone would get rich from the future profits, and people believed it. Stock prices started to climb. Investors flooded in. By 1720, mania had taken hold. Never mind that Britain was still in war with Spain and couldn't actually trade with South America at all. The South Sea Company was given the monopoly to Asiento de Negros for 4,800 enslaved people per year. But the Spanish were not stupid and levied a kind of tax on this, in brackets, cargo. They also allowed only one ship per year in each port of South America. These restrictions were bad for the South Sea Company, as the profits would never be sufficient to pay off the national debt it had taken on. Instead, the idea was to find more and more new investors. Selling new shares was easier and also brought in a lot of money. From its headquarters in London, the company launched a massive campaign. Today we would call it a public relation campaign, to sell even more shares. A success for the South Sea Company would be a success for Britain and worthwhile for the shareholders. Many aristocrats, politicians and celebrities took the bait and bought shares en masse at exorbitant prices. This even included famous people such as the author Jonathan Swift. Even Sir Isaac Newton got into the action. Yes, that Isaac Newton. To convince the last doubters, the company secured the support of the English king. King George I was appointed governor of the South Sea Company. Many believed that nothing could go wrong anymore. With this promise, a trading monopoly secured by the English king and the government, the South Sea Company was considered too big to fail. However, the average annual income of ordinary people was not enough to even begin to consider buying shares. The annual income of a teacher, for example, was £13. That of a doctor, £30 per year. A high-ranking government official had an impressive annual salary of £62. But a single share, however, cost £100. It was way too expensive for most people in the UK. The South Sea Company therefore offered to lend money to new investors so that they could buy more shares. This is unimaginable today, but at the time it drove the share prices even higher. The stock price soared. The company used dirty tricks to keep the momentum going, bribing politicians, planting fake news, and fueling the frenzy with grand promises. In January 1720, the share price was £128. By April, it had risen to a breathtaking £350. This corresponded to a gain of 275% in just a few weeks. The price continued to rise, reaching £600 in May and £950 by end of June. The inflated share price peaked at £1,050, which would have meant a theoretical gain of 820% in just about 6 months. By late 1720, people started to question the company's actual business. There were no major profits, no South American riches, just speculation and hype. Panic set in. Investors rushed to sell. The price collapsed. The South Sea Company's share price began to fall as investors realized that the rumors about the slave trade monopoly were false and that the company was not as profitable as claimed. The share price collapsed to £190 in late summer and to just £124 by the end of the year. The speculative bubble surrounding the South Sea Company had finally burst. The crisis spread to other companies associated with the South Sea Company, and the entire European economy was affected by the crisis. The consequences of the financial crisis were devastating. Thousands were ruined, pensions were wiped out, suicides followed. Many people lost all their assets, and the British government was forced to take extensive rescue measures to save the country from economic collapse. Numerous investigations and prosecutions have been launched to bring those responsible for the crisis to justice. Parliament launched investigations. The scandal reached the highest levels. Directors were imprisoned, fortunes were confiscated, and even the Chancellor of the Exchequer was implicated. But what was Error 1? The idea of using a listed stock corporation to eliminate government debt certainly sparked interest. However, it's puzzling how so many people, including the brilliant Isaac Newton, fell for this deception. The main problem, in my opinion, is the human perception filter. As humans, we are generally risk-averse when it comes to our money. However, when the potential profit is so extremely high, our brains switch over and we start imagining all the things that we could do with it. This emotional process is largely unrelated to rational decision-making. This effect intensifies when many people join in. We crave to be part of it and become incredibly wealthy with minimal effort. As prices rise, it becomes increasingly convincing to buy shares. This further fuels the desire to join in and profit. This psychological phenomenon known as social proof is one of the most prevalent causes of speculative bubbles. The South Sea financial crisis, which occurred almost exactly 300 years ago, highlights that human behavior has remained largely unchanged in this regard. Even today, irrational exuberance continues to manifest in the markets. From the Black Friday crash in 1929, which triggered the global economic crisis, to the dot-com bubble in 1999, and to the real estate bubble in 2008, which led to the last major financial crisis. These events demonstrate the cyclical nature of market fluctuations. We are still susceptible to emotional mistakes triggered by social proofs today. And this is also what I believe the Error 1, which led to the very first financial crisis in 1720. Incidentally, Isaac Newton lost £19,000 in the South Sea financial crisis. Converted, that would be around $6 million today, a considerable sum for a scientist. Newton had a simple explanation for his wrong decision. At the crucial moment, he had lost his mind, he said. Or rather, others around him had lost theirs. When asked later about the bubble, he reportedly said,
"I can calculate the motions of the heavenly bodies, but not the madness of people."
And he lost his fortune. The South Sea bubble didn't just crash an economy, it shattered public trust. But oddly, it didn't kill the stock market. In fact, it even helped shape financial regulations for centuries to come. Laws were passed to prevent shady joint stock companies, and the Bank of England's role grew. The idea of central oversight began to take hold. The bubble had burst, but the lessons endured. Speculation is as old as ambition, and just as dangerous when untethered from reality. So the next time someone promises guaranteed returns, or the next big thing, think of John Blunt, a shipless company, and the investors who learned too late that not all treasures are real. And this was Error 1. I'm Eckhard Jan, and thank you for listening. If you enjoyed this episode, please share it with a friend or your financial advisor. And remember, bubbles always look like opportunities until they pop. If you want to learn more about this concept, you can now download my award-winning book Error 1 or just visit www.error1.net. With this in mind, I say thank you very much, or as we say in Germany, bleib Sie sicher, stay safe, and talk to you next time. Bye bye.